Good afternoon and welcome everyone to our call. Thank you for joining us. We're thrilled to have you here. Today we are going to focus on the administration's proposal around infrastructure and the impacts of that on both the markets and the taxpayer. We are joined by Leah Bennett in Houston. She is president of our Westwood Wealth Management office there, and she is a portfolio manager for several of our wealth solutions, including Select Equity. We are further joined by Adrian Helfert. He is our Chief Investment Officer for Multi-Asset Portfolios, and we're thrilled to have them both here. They will provide lots of great insight on what they're seeing across the broad spectrum of the financial markets. And with that, Leah, I think I'll turn it over to you. Thank you.
Thank you so much, Shana. As many of you all know, there's been the proposal is outstanding regarding infrastructure and stimulus, additional stimulus for the U.S. economy. So, Adrian, I'm kind of curious if you could just discuss the proposal in general and how is it changing, or is it changing your investment thoughts?
Sure. Well, it certainly does, and thanks for joining today and listening. The American Jobs Plan that we saw just introduced at the end of March proposes around $2 trillion of government funding over the next decade. When you look at the full Build Back Better agenda, that's now around $4 trillion of spending over the 8 to 10 year time horizon, with about $3 trillion in taxes, which is going to be a key element of the discussion. The focus of that spending is on infrastructure, updating our electrical grid, communication networks, and certainly green causes like addressing climate change, with the stated goal of all of this being job creation. It's interesting as you read through the plan that they specifically mention out-competing China as well. So we'll see actually where they start to chop away at that. The plan is a pretty significant departure from what we've seen as a previous vision of government spending and infrastructure in the past. So we're going to see I think a divergence from some of the sector performance, but it's also still just a plan at this point. There's a lot of things that may change. Now, many of the measures in that plan, they reflect that the president's goal of achieving 100% carbon-free power generation by 2035. We'll talk a lot about this, which is he has calls right now for creating a national energy efficiency and carbon and clean electricity standard for America. So you'll see a key push on R&D, on spending for infrastructure that's going to be in that area. As far as markets, of course, we've seen markets since March of 2020, when we saw that dip from the great virus crisis. The effect of broad stimulus and monetary policy has helped support markets. It lifts all the boats. Now, the old adage of follow the money trail not only works in crime fighting, but it works in markets, where now we have more transparency. Now we can look and see where the spending is going to occur and where it's not going to occur, which leads us down the path of where we actually might see good performance, where we might see outperformance, what industries might have more regulation, and of course not see what the usual spending is. If we look at some of the details, just to drill down a little bit, of course there's a significant update to public infrastructure. You start to think lots of raw materials, copper, concrete, input cost for building bridges and roads. The plan does eliminate tax preferences, loopholes for traditional energy, so that may have an impact on their bottom line. The plan also focuses on infrastructure and investment at the lower end of the economic spectrum. So that could have a higher immediate discretionary impact on spending, as generally that multiplier on the lower economic spectrum, as they have more income, leads to more of that. So I think a key measure of this, as we start to think about what President Biden and the administration are going to look forward to, is the key measure of success. What's the key measure of success at the end of his administration, certainly term one? And it's going to be green job creation. We've been telegraphed that very well, and it will be versus other nations. We're in competition right now, which is why we saw that out-competing China specifically mentioned in there. So that'll be lots of grant spending to tech and R&D for those individuals that are producing green cars, EV cars, et cetera. Those are areas that are going to be key investment themes over the next certainly year.
Yeah, I think it's interesting. If you look at even before this bill was announced, you had all these a lot of major auto manufacturers coming out and saying we're going to move to 100% electric vehicles by 2025, 2030. Obviously, Tesla and others that have been leaders in this area, and we just don't have the infrastructure to really support such initiatives. So, in a lot of senses, there's going to be spending around infrastructure to support those initiatives anyway. So, it's, I guess, not a surprise to come out and see this particular bill proposed. I do think materials, like you mentioned, are interesting because they do benefit certainly from infrastructure spending, but also just as the global economy rebounds from COVID, there's going to be increased demand, especially from emerging markets. So I think materials is an interesting area anyway. And then if you look at sustainable fund flows, I was looking, they've actually constituted a quarter of overall net fund flows this year from both stocks and bonds, which is interesting. And so I would think from mutual fund flows. And obviously you'll continue to have money come into that area. I'm interested, it is an environment where the correlation between securities is still relatively low despite all the stimulus that's been out there. Where else are you kind of seeing pivoting from a macro perspective?
Well, from a macro perspective, and actually I'll step back and say that's a really good point around that you're making around the EV and the targets that they've had, and that preceded this bill as well. If we've actually seen that groundswell, just looking historical precedent where decades past, we have been supporting the traditional energy industry as a key geopolitical geopolitical importance to our nation. It could be, and I think it is likely going to be, as we're seeing this in the bill, that we're going to subsidize, rather than that area, we're going to subsidize strength and leadership in EV technology. Think batteries, think having rare earth materials that right now are heavily controlled by Asia. We're going to be more concerned in those areas that are going to be the lifeblood of economic growth. As far as macro considerations, there are numerous, certainly, and it is a big topic of discussion, what happens with the US Fed in interest rates and continued fiscal stimulus on just support metrics, i.e., do we continue supporting jobs as the main driver as opposed to watching inflationary metrics more closely? And because things like this usually are inflationary, we're pumping money into the environment, so much so that you would anticipate that costs are going to go up, and they are going up. Lumber prices are up over 100%, in part because house prices are doing so well. But certainly look around at copper, which is up 50+% over the last year. There are other areas where yet we're going to ignore it for a while. You can only do that so long before I think the Fed gets concerned. Consideration is going to be, when does the Fed really pull the punch bowl? When do they come back and raise rates? Because that historically is the end of a cycle.
Yeah, and I think that's a very good point. And actually on that topic, I mean, this is a huge bill, and there are all these questions about affordability and thinking about how the administration plans to pay for this. So I'm kind of curious what your thoughts are. Obviously, there's a proposed tax plan, but what are your thoughts about the tax plan as it relates to the bill itself?
Well, that is the next question, certainly. Item number one for the administration is higher taxes on corporations, which makes the landscape for the next 4 years a lobbyist's dream, because we will see lobbying for various corporations and for industries trying to move the needle as far as taxation for their own areas. There are a couple of things proposed, but I think this is an area where we have less transparency on what's going to be allowed through and how they're going to pay for it. What's been proposed so far, of course, is a permanent adjustment. They call it permanent, but it doesn't always have to be, of the corporate tax rate from 21 to 28%. Recall that President Trump decreased the corporate tax rate from 35%, where we were one of the highest in the world, down to 21%. So this is not moving back all of the way, but it's moving back some of the way in the proposal. There are other areas we are looking at, and just seeing some headlines on this today, introducing a global minimum tax of 15% to 21% for U.S. multinationals. I believe they said 21%. Now it's being talked at a little lower rate, but still it's a global minimum tax that they're saying should reduce the pushing of your profits to tax havens to reduce your tax liability, which is effectively a loophole in some metrics. Ireland, which has a very low tax rate, is one of the main countries pushing back on something like that. We are looking at enacting a 15% tax on corporations for their book income, which is trying to reduce loopholes in corporate tax policy. And we are, of course, as I talked about fossil fuel companies, they're moving away from that. That's a reduction where they're ending subsidies or tax loopholes for U.S. fossil fuel companies. Of course, then we're going to shift the dial, as we've been talking about, potentially giving subsidies and R&D credit for those that are on the clean energy side. So, looking at that, there's going to be a reduction in tax breaks, and those are things that are more policy oriented. There's a lot of press that was recently around. There were at least 55 large companies that paid zero tax, and this is primarily because of things like capital expensing, which allows you to take your depreciation schedule and accelerate it massively. Things like R&D cost write-offs and stock option expensing. So I would anticipate we'll see a lot of discussion around that. Individuals, it's less clear what happens, and we haven't really seen discussion of that in the stated policy. Of course, we saw the possibility of moving the top tax rate from 37% to 39.6%, but we haven't seen further mention of that. There's talk about taxing long-term and short-term capital gains at ordinary tax rates. So once again, this is pushing the burden onto high earners, and we haven't seen the full analysis yet. But how we pay for it is always a discussion, regardless of administration, of how much growth it actually stimulates. And there's all kinds of assumptions and anticipations around that, because if it kicks off growth in a big way, then of course revenue comes in, because growth means more revenues for the government, and they consider that a way to pay for it. But it's a model. And so there will be a lot of discussion around, is the model correct? Is this how we're going to stimulate growth? And we'll see more on that.
And you're right. I mean, and this is such a fluid topic. I mean, even there's news coming out today, kind of as we speak. There's just constantly material coming out on this particular topic. And I agree on the individuals. There's so much speculation as far as what can happen. Obviously, people who are making over 400,000 will certainly bear the brunt of what's going to occur. We've also seen there's speculation. It hasn't been in print yet, but that the step up in cost basis is something that's being reviewed, whether or not that could be eliminated when someone passes. And then I think it's a great opportunity. There's lots of discussion around the estate tax exemption, which is currently at $11.7 million per individual, to be reduced around $3.5 million per individual. And so you're in kind of that unique window where you can do planning. So if you do have a taxable estate, or are going to have a taxable estate, so let's say let's say we assume it's $3.5 million per individual. Even if you have a $5 million estate and you are relatively young and those assets are going to appreciate, you have the opportunity to gift and get assets out of your estate, either by gifting to creating a trust for your child, or creating a spousal lifetime annuity trust for a spouse, or doing some charitable planning. And then once you pull those assets out of your estate and they appreciate, all that appreciation is not subject to that estate tax. And currently, as I mentioned there, it's $11.7 million per individual, possibly going down to 3.5. And then the estate tax itself is at 40%. And there's some speculation that will move up to 45%. So lots of potential changes, and it is a great window before you get the announcements to have the opportunity to act. And this is worth mentioning. It's the largest tax increase, the biggest tax increase as far as a bill is concerned since 1968. So for quite a while. And with that, I'm kind of curious, because obviously this news is out there. Adrian, why do you think the markets have been so resilient?
Well, I mean, two major things. One is big government spending, and the second is reopening. They are enough to offset what is concerns around the tax bill. Now, on the big government spending side, of course, we are in the midst of still fiscal stimulus, certainly with the bill itself. And we're in the midst of reflation of an economy that's not only virus driven from a consumption void that we came out of. I mean, people can't wait to go out and buy their new Nike shoes to take to school and show once we get back to school and back out there. So there's a potential of a large share of spending coming off the sideline that has previously been sidelined with elevated savings rates of the economy. But pair that as well with there's increased housing wealth. The housing market has been a rocket ship, and it's extraordinary what's happened there with interest rates being very low, potentially with labor mobility increasing. That has helped housing market go up, it's a wealth effect. It's a multiplier effect as well on spending. So that's certainly helped. Low monetary policy has undoubtedly been a big piece of that. The Federal Reserve has said they're going to keep interest rates low, extraordinarily low, which allows corporations to borrow cheaply and spend for new projects, buy new widgets, hire people to manage those widgets. It pushes you out the risk spectrum, increases the wealth effect as well. It's called the portfolio balance channel. So that's been a positive in support. And certainly there's uncertainty. As I said earlier, this is still a plan, and it's uncertain what's going to make it through. It's uncertain how we're going to agree we're going to pay for it. And as far as the taxes go, we recently had the death of the Florida Representative Alcee Hastings, the House Democrat. I mentioned that because that means we're down to a razor thin margin in the House. And because of that balance, that means it's going to be a lot of jockeying. Senator Manchin's already come out in opposition to the 28% tax rate. Previously, he said something around a 25% tax rate. So you're starting to see where the market and investors like myself are saying, I think it's unlikely that the House and the Senate are going to be able to push through too much without the support of every single person and without going down a very acrimonious procedure. So there's uncertainty of what's actually going to be enacted. And we talked about this prior to the election of, one of the possibilities is a full blue outcome means lots of spending, meaning they'll find it more likely to push through spending bills, fiscal stimulus, those things that near term are good. Whereas longer term, it's harder to figure out how we're going to pay for those things. It's going to be more difficult to push through tax areas. So I think that's a big piece of it. Historical perspective, when we talk about 2017, we went through something similar where the 2017 tax cuts were negotiated. We didn't see a lot. That was just the second half of 2017, and there wasn't a whole lot of movement on that. And I used to watch these tax-sensitive stocks. There was almost nothing moving, even as we were talking about this extraordinary change in tax policy. It wasn't until a month before it was enacted where we saw the movement. And so I think more transparency is going to be required, which does mean that we'll keep our eyes on the ball. And as we get around to more transparency on what actually is going to happen, we'll look at market expectations closer.
Yeah, and I think that's a very good point. As far as even if you look at the Senate, it being fairly even is a positive as far as both parties having to compromise with each other, and then you don't get anything that's hopefully too extreme pass. I mean, there is some checks there, which is encouraging. I also think it's interesting, back to your point about the reopening trade. I mean, you're definitely getting, like, some of the travel companies are coming out now, some of the cruise companies, and saying their cruises are booked up. You're definitely seeing future travel starting to book up. I myself, and I think you are as well, Adrian, are kind of ready to get out there. So I think there's definitely things that people have missed that they're looking forward to participating in, and there will be some pent-up demand from those activities. I know we've talked in the past about the amount of innovation and how a lot of companies have really addressed their expenses during this period. And I was taking a look at operating margins, and if you look at, they have just rebounded significantly. I think on the S&P 500, the operating margins are around 15.8%. The all-time high that we've ever had was in 2018, and that was 16.5, and we are still moving rapidly upwards. So I think there's certainly the possibility that we could get back over 16.5%. If you think about companies as they're reopening, their variable costs will go up. They'll certainly have to hire more people, especially hospitality and travel and hotels. A lot of these areas that have been really adversely affected during COVID, but a lot of their fixed costs have really changed dramatically. So I think that element is certainly supporting the market as well, and it'll be interesting to see kind of how that plays out, especially as we get into earnings season in this first quarter. Looking at the first quarter, and this is the last time that we'll kind of anniversary a period before we got into COVID.
Yeah, agreed. And those are great points on, especially on the operating margin side, where we saw companies furlough employees en masse, and we saw the labor rate change. We're still at an elevated labor unemployment rate, which is running right around 6%. That's elevated for history, and it's one reason why the Fed is keeping rates low, as they are observing that as something that we need to push down further as a key goal, just as the jobs plan says as well. I think many companies have looked at efficiencies for their operations, as you're mentioning, during this period, number one. Number two, necessity is the mother of invention. And companies have looked at pulling forward plans on how to create efficiencies in their companies that, as we see demand come back, is going to be a strong multiplier for their earnings, for their bottom line.
Yeah, I completely agree. Yeah, and it's even interesting. I think some companies, they're not even comparing when they're doing year-over-year comparisons. They're not even comparing to 2020. They're comparing back to 2019, and a lot of them are seeing increases. So it's just going to be interesting to see how this all bears out as the year continues to evolve.
Agreed.
One last question. So we've been talking about a lot of the challenges. Obviously, there's some positives with the stimulus bill. Negatives are around cost. We're talking about higher tax rates. I'm just kind of curious, do you think the positives outweigh the negatives? Just kind of what are your general thoughts?
I think the positives outweigh the negatives, yes. I think there is still a lot of opportunities in the environment. As I talked about, consumers are coming out of their hidey holes, myself included and yourself included, as we're looking at travel. I'm not going to buy the new Nike sneakers, but there are other areas that I'm looking at deploying capital, like many are. That's a positive prospect, and I think we're going to see a second quarter earnings season unlike anything that we have seen. It's anticipated to be extraordinary. Now, granted, with that positive outlook, without a lot of things, it's not like the Brazilian steakhouse where you've got the shift from either yes, please give me lots of meat, or take my plate away. There's the balance that's required. And the balance that's required is observing those risks and what things could go wrong, which is one of the genesis for us talking about taxes here. What could go wrong is inflation. We talked about operating margins. We talked about the amount of fiscal stimulus that's going in. If we start to see a spike in inflation, which we don't see yet, but if we see a spike in realized inflation, that puts pressure on those margins, that puts pressure on input costs for companies, potentially a pass through to consumers who reduce their spending rate, and it puts the pressure on the Federal Reserve to pull that punch bowl away. All of those things would be a concerning dynamic. We don't see that yet. We see anticipated inflation moving up a bit. Now, realized, not so much. Certain areas, yes, but broadly for consumer price inflation, that's not a major concern. Corporate tax rates, yes, those are concerning. There's just not enough transparency of where they might get to. Broadly, we've looked at this issue as how much it could impact companies, and it's between 6 and 9% on earnings per share impact. Granted, even with that, 2022 expected earnings are still significantly higher. The expected earnings on consensus right now are just above 15%. So even with a 6 to 7% impact, we're still at a pretty strong earnings season expected, and that's far enough in the future without enough transparency that we can't opine too much on that yet. So there's positive things to be said, investors will say, well, where's the balance? Where should I have that balance in our portfolios for the defensive aspect should we see this downturn? Fixed income, there is some of the fixed income aspect still there, even at low interest rates. I think it's decent for investors to have some of that because we've seen how low they can go, and it's much lower than 1.7% on a 10-year, which is about where we are today on a government security. There are other areas of just having some defensive mechanisms with high dividend equity, with potentially having investment in real type assets. Real type assets are things like, well, real estate certainly, but in the markets of, as you were mentioning, the materials sector, as we see investment in stimulus, even if it creates inflation, those things participate in inflation. So we may see a shift further towards that. And then the opportunities, of course, are potentially in those companies that could gain from this, those that are less concerned about rises in interest rates, like financial companies, potentially like energy companies that will participate in some of the traditional energy increase as demand goes up, as the economic potential goes up, but also make a transition further in investment in clean energy.
Yeah, and I do think it's interesting and encouraging that the 10-year has, I hate to use the word stalled out, but has kind of lost momentum around 1.7%, which is a little encouraging for the markets as well.
I agree. I think there's a natural escape valve there, or it's going to be fits and starts for us to rise significantly because the discounting effect on equities makes it difficult. It removes that wealth effect from the market and thus impacts economic growth. So we can't move up too fast or too far ahead of the economy itself. It can move up further, and it will move up further, in my humble opinion, but it can't just do a step change up. It needs to correct with expected economic growth.
It's going to be interesting to see. Again, it may be a situation where both economic growth and some of the transformation that has happened during COVID outweighs policy. That's certainly a possibility. And it'll be, and I do think it's an environment certainly where you have to be risk aware because you've kind of underscored a lot of the risks that are out there. But yeah, it's going to be interesting to see how the rest of the year plays out for sure.
I agree. We'll keep mindful of the downside potentials, or as we've been told before, of the known unknowns, the unknown unknowns. All of the above we'll certainly be mindful of, and that's why it always pays to have the balance in the portfolio. As I said, from a summary standpoint, we're opportunistic. We are still positive on the outlook for the economy. There's so much that has been created in stimulus, and yet the Fed is still, they're not pulling the punch bowl. They're refilling it with the flask. So it's a very good environment as far as investors are looking at this for potential growth. It's just that now, as I said about follow the money, now that we have at least a little more transparency, it allows us as investors to be more granular about our investment, to actually perform selection a whole lot more than in the past of those beneficiaries, the winners and the losers. So that, I think, is the next real step.
Yeah, no, I agree. And Adrian, thank you so much for being with us and kind of sharing your thoughts. They're always insightful, and appreciate your time. And thank you for everyone who dialed in. We really appreciate your support of Westwood, and we look forward to talking to you again for our next call. Thank you so much.
Thank you, Leah.